The story of Nakilat is one of claiming control. A kingpin in the Qatari LNG value chain, Nakilat has navigated rough waters and has emerged as a beacon of stability in the Qatari stock market. We are Team Qatar University and we issue a buy recommendation for Nakilat with a target price of 5.33 Qatari riyals, representing an upside of 35% from the closing price as of May 6th. Our buy recommendation is fueled by 5 main pillars: an unwavering government support, a strategic location, successful synergies from joint ventures, a stable, low-risk business model, and an attractive dividend yield.
Now, let us set sail and dive into Nakilat's story. It all begins in the early 1990s when Qatar turned its focus to the exportation of liquefied natural gas, LNG. Whilst initially large international companies took control of the midstream value chain, the Qatar Gas 2 project changed that. And in 2004, Qatar Gas Transport Company, Nakilat, was formed. Nakilat's mission was clear: to solve ownership control and profit issues by 1. Becoming an essential link in the LNG supply chain, and 2. Enabling its Qatari citizens to invest in the LNG industry. Now, Nakilat as an LNG transporting company has become a global power, enabling Qatar to connect with over 40 countries all over the world. With a fleet of 99 vessels, Nakilat is the second largest LNG exporter in the world. Since its creation, Nakilat has had unwavering government support from Qatar Energy, the state-owned oil company in Qatar, and recently secured long-term contracts for the North Field expansion project, Qatar's largest oil expansion project in recent years, contributing to high earning visibility. Nakilat has 4 main revenue streams: wholly owned vessels, shipping joint ventures, shipyard joint ventures, and marine services. The 29 wholly owned vessels account for majority of Nakilat's revenue with 77%, followed by shipping joint ventures with 17%.
The LNG industry is seeing a strong confluence of growth: rising LNG demand, expanding liquefaction capacity and supply, and increasing fleet sizes by major players. This positions Nakilat well in order to leverage its experience and well-sized fleet to support any growing demand and upcoming projects. Nakilat also thrives in the niche within the shipping LNG landscape. Dominant in the MENA region, they compete with major global players from Japan, Malaysia, and Australia.
Charting a course towards sustainability, Nakilat anchors its commitment through a number of initiatives. By establishing an ESG committee and transitioning to zero ODP in 2021, Nakilat demonstrates its focus on the environmental pillar. Socially, the company provides around-the-clock health checks and health insurance, and on the governance front, Nakilat's business continuity management workshops and training ensures resilience in the face of unprecedented circumstances. We see this reflected in their improved ESG scoring throughout the years. Compared to its peers, however, Nakilat holds a contested position. Whilst Nakilat's dedication in targeting ESG through its initiatives is commendable, with relatively higher GHG emissions and no female representation on board, the company lags behind, particularly in the environmental and governmental aspects. This presents Nakilat with opportunities for improvement. Utilizing Nakilat's materiality matrix, we recommend a focus on 3 key issues: environmental transparency, especially in disclosing Scope 3 and Scope 2 emissions, as well as GHG emission reduction, enhancing gender diversity in both staff and board, and optimizing executive remuneration policies for an improved governmental score.
The structure of Nakilat business fosters predictable revenue generation. Significant revenue growth is spotted in the year 2026 in line with the North Field expansion project. Contribution of the revenue from the newly acquired vessels to Nakilat's revenue, as well as their long-term charter revenue agreements with their joint ventures, further contribute to these steady revenue streams. The team also built a robust revenue forecast model, utilizing incremental revenue from new vessels as our key data point. Taking the yearly fleet expansion into account, as well as the long-term charter rate, the team was able to determine the incremental revenue from each new vessel. The team also performed a margins analysis. Nakilat's EBITDA margin is considerably higher than the industry average at about 75%. We believe that this is due to Nakilat's operational efficiencies, as well as their economies of scale strategies and unwavering government support in the form of their long-term charter agreements with Qatar Energy. Nakilat also boasts strong net and operating profit margins, as a result of higher revenues from joint ventures and low interest expense over the forecasted period. Nakilat's CAPEX per revenue ratio is expected to reach about 72% in 2026 as Nakilat undergoes strategic investments for expansion. We expect this ratio to decrease to about 55% in 2029 as a result of the contribution of the newly acquired vessels to Nakilat's revenue. Historically, Nakilat has utilized 80% debt to finance their expansion projects, as a result of which Nakilat has an above-average debt-to-equity ratio of about 160%. We observe this ratio declining over the forecasted period as a result of repayments of significant bank loans and corporate bonds. Substantial improvement is also anticipated in the interest coverage ratio, reaching 3.69 in the year 2033 due to steady cash flow streams and the upcoming expansion further contributing to these steady revenue streams.
As for the valuation, the team used a blended valuation model, allocating 60% of the DCF, 30% of the relative valuation, and 10% of the DDM. This gave us a final target price of 5.33 Qatari riyals and an upside of 35%. The cost of equity of 7.5% was arrived at using the CAPM model, and the cost of debt of 6.1% is the yield to maturity on Nakilat's long-term corporate bond coming due in 2033. This gave us a WACC of 6.93% for the firm. The DCF model uses two growth phases, with 86% revenue growth forecasted in the initial 10-year period, after which a perpetual growth rate of 2% was assumed. The DCF provides us with the target price of 5.56 Qatari riyals and an upside of 40%. As for the relative valuation, because of the capital and the debt-intensive nature of the industry, the team considers the EV/EBITDA multiple as a pertinent factor for our relative valuation. Comparing Nakilat to 5 global peers in the oil and gas transportation sector, we get a target price of 4.67 Qatari riyals from the EV/EBITDA multiple, giving us an upside of 18%. And the PE multiple provides us with a target price of 4.98 Qatari riyals and an upside of 26%. Now, keeping in mind Nakilat's generous dividend policy, the team conducted a DDM analysis as well. In the initial forecasted 10-year period, a steady dividend payout ratio of 61% is used. And the DDM model provides us with a target price of 5.64 Qatari riyals and an upside of 42%. Nakilat currently lags behind its peers in terms of ESG, and to reflect this into our valuation, we have taken the DDM model with an ESG-adjusted beta, in the DCF model with an ESG-adjusted beta, in our DDM model through a higher cost of equity, and in our relative valuation through a discount to the industry average multiples. The ESG-adjusted final target price is 4.95 Qatari riyals, giving us an upside of 25%, but still upholding our buy recommendation.
In order to visualize the impact of 8 key variables, we developed a tornado graph. The long-term charter rate is the most important variable due to its direct impact on Nakilat's revenues. We also conducted a stress test by changing 3 variables to give us a bull, bear, and base case scenario. In our bull case scenario, we have a 69% upside, giving us a buy recommendation. And in our bear case scenario, we have a 3% downside, indicating a hold. To ensure a dynamic sensitivity analysis, we also conducted a 2-variable data table, bolstering our buy recommendation with an 80% probability. As for our Monte Carlo simulation, after targeting 3 pivotal factors and running 30,000 simulations, we arrived at an astounding 98% confidence level, cementing our buy recommendation across the board.
There are some risks to our valuation, which we categorize based on level of probability and impact. The current Red Sea tensions pose the biggest threat to our valuation. This is because the Strait of Hormuz, a critical route for Nakilat's vessels, can be impacted by any escalation. In order to quantify this, the team conducted a scenario simulation. As Nakilat is engaged in take-or-pay contracts with full cost pass-through, including insurance to charterers, the impact on the firm's operational costs is minimal, yet the investor sentiment could suffer. Overall, our scenario simulation reinforces our buy recommendation. Taking into considerations our merits and concerns, we reiterate our buy recommendation for Nakilat with a target price of 5.33 Qatari riyals with an upside of 35%. This has been Team Qatar University. Thank you for listening.
I think historically, given that the company has benefited a lot from Qatar Energy's expansion, but going forward, the North Field expansion is actually very significant. How will this impact charter rates going forward, given that the company cannot fully supply to Qatar Energy's needs?
Absolutely. I would love to take that question. That's actually a very interesting question because the Nakilat's business model is very unique. The charter rates that are in the market, which is both the voyage charter rates and the time charter party rates, are market rates and they are influenced by the market factors. But what happens with Nakilat and Qatar Energy is that there is an ongoing negotiation between them in order to arrive at a specific target charter rate. It is influenced by the market, but then again, it depends on the relationship between these two companies. And that is why we believe that the 95,000 charter rate is relatively independent of what is happening currently in the market.
Thank you for your presentation. And my question, I want to ask a bit about the stress testing that you did, of how you selected the factors that you selected. In addition, I was somewhat surprised not to see a consideration of just the price of gas. So could you talk a bit about the factors that you selected for the stress testing, as well as if this company has any correlation to the price of gas?
Thank you for that question. So could you please go to slide 25? Thank you. So the different factors that we have taken into consideration is the charter rate, first of all, which influences the revenue CAGR, the WACC of the firm, and the perpetual growth rate. This is again influenced by our 20-year graph as well. As you can see, the most important factors are our long-term charter rate, and we wanted to take that into consideration. As for the price of gas, you've raised an interesting point because of the nature of the contracts between Qatar Energy and Nakilat, they are take-or-pay contracts with full cost pass-through to Qatar Energy, meaning the price of gas does not affect Nakilat because they are locked into these long-term contracts that are stable and they stretch for a long period of time.
So if I understand correctly, it's not really about like the major business risk is not really about gas price. It's actually about what will be the outcome of negotiations between Qatar Energy and Nakilat, and being very frank, what part of the profit will be actually allowed to be stayed in Nakilat and not stay in Qatar Energy or the budget of Qatar. Is that correct?
That's a very interesting question as well. Thank you so much. So as for the amount of profit that Nakilat takes in through these contracts, the charter rate is actually influenced by two factors, both the negotiation power that Qatar Energy has, and it depends also on their contracts with the LNG purchasers. But at the other hand, it's also important for Nakilat to maintain a certain ROI on the huge capex that they will take on. And in order to do so, Nakilat's team has a robust process through which they see the economies of each vessel that they acquire. And that is why in order to earn a 14% ROI from each vessel, they use a certain charter rate. And our charter rate of 95,000 perfectly fits in with their desired ROI.
If Qatar Energy allows, I guess. What's the shareholder structure Nakilat compared to Qatar Energy? I guess probably Qatar Energy has more state involved than Nakilat, right?
Qatar Energy is a state-owned enterprise, and as for Nakilat, Qatar Energy has a stake in Nakilat as well through Milaha.
But I guess it's lower than in itself, right? If it's 100% state-owned, I mean Qatar Energy, it's 100% of the state of Qatar, and Nakilat is definitely a smaller percentage, right?
Okay, so thank you very much for that question. So when let me get you right. You're talking about Qatar Energy's impact in regards to Nakilat's business, right? Their
exactly.
ownership,
the pricing power of Qatar Energy versus Nakilat, because from what I can see, Nakilat is more a price taker than anything else from Qatar Energy.
Okay, so can you please go to Appendix B, B1, please. So Nakilat, what we see with Nakilat is that the reason Nakilat even came to be, this was Qatar realized that they originally, when they entered this industry, they were taking low ownership control in their transportations. However, Qatar Energy realized the benefit once they were becoming stronger and they were becoming more competitive in the market, and now as the second largest LNG exporter. They realized that we can take control of this midstream value, so let's create Nakilat. So Nakilat created was with the intention for Qatar to benefit as a whole. So when we talk about Qatar Energy, state-owned company, they also benefit when Nakilat receives high revenues. And that's why when they're negotiating, they're seeing what works with both of them. So when Qatar Energy joins into, when they're talking about their contracts, per our information, they make sure that it benefits them both. Because when Nakilat benefits as a stable defense stock, the country as a whole benefits.
It's a bit difficult to negotiate with your owner. Okay, what's your opinion on the LNG market worldwide? As you know, there are various things going on. On one hand, you have this Green Deal issues going on and Paris agreements. On the other hand, you have a major change in energy supplies in both Europe and Asia. What's your opinion on LNG during next years?
Okay, thank you very much for your question. Can we please go to E1, please? So what we observe in the current climate with LNG is a transitional gas. So more countries are trying to move towards it. What we see, the biggest importers currently per economic data is Europe and Asia. And with Europe, due to the Russian-Ukrainian crisis, they've realized that they need to diversify because they were highly reliant on Russia, with 90% of its imports of gas coming in from Russia. However, they were like, this is time for us to diversify. And they have signed the Versailles Declaration 2022, in which they have announced that they plan to remove 90% of their reliance on Russia forward. And this actually opens an opportunity for Nakilat and other companies to take advantage of this this new coming out segment and grab it and have a higher market share.
And I would also like to add on to what my peer has said regarding your question about Paris agreements and the green, I guess you can call it revolution. It's basically, can we turn to C1? Yeah. So Nakilat is well aware of having to be environmentally friendly, and that's why they have taken on ESG initiatives to partake in this green energy movement. But not only that, but we have also, it was Shell. So Shell has forecasted that there's going to be an increase in LNG demand over the course of until 2050. So Nakilat is basically taking advantage of that.
Thank you.
Historically, the company's overall growth has been fueled by debt. Post the 25 new vessels that are incoming, with the net to debt equity ratio actually put a cap on future expansion.
So as mentioned before, Nakilat has above average debt to equity ratio. But we would like to point out that Nakilat's debt is actually backed up by their steady revenue streams as a result of their long-term charter agreements with Qatar Energy and other joint ventures, as well as when these acquired vessels come into operation, they're going to further contribute to Nakilat's revenue and result in backing up the debt and resulting in a more secure debt profile. So yes, till now, they have utilized 80% debt to finance their expansion, but they also have strong revenue streams supporting this debt.
Just adding on to my colleague's point here, it is important to note that Nakilat's credit rating has been upgraded by the three main rating agencies over just the past year. And just in this February, the rating by Moody's has been, and it has one of the highest credit rating for any shipping company worldwide. And Moody's just upgraded the rating to AA3 for Nakilat, which further solidifies their capability to actually service the debt that they will take on in the future.
I want to ask a follow-up question, mostly on the revenue side. It's certainly notable most of the revenue is coming from the wholly owned vessels. The investments that they've made, will that grow then, or are they seeking to diversify the revenue base? How does that compare to other competitors?
Absolutely. I would like to take that question. So your question is whether Nakilat is aiming to diversify to other areas of the business as well. And this is actually an interesting question because Nakilat's main USP is the fact that they are able to operate the largest LNG vessel in the world, which is the Q-Max vessel. And that operational capability is not there with any other competitor in the world. And that is why they focus on their LNG operations, but have continuously tried to diversify to, for example, their shipyard segment, which is which is cyclical in nature, but with the increased shipping activity that we are expecting over the forecasted years, especially in the region, with the LNG capacity increases from Qatar Energy, but also from other countries, we believe that the shipyard segment will also start contributing higher revenues for Nakilat.
You showed us around 5 or even more slides relating to ESG and the positive influence of various ESG activities on the company, and you even mentioned that you are upgrading the valuation based on ESG. If you could please tell what exactly areas of ESG, in your opinion, have the influence on valuation or company's result. Hint: no marketing, please.
Could you please rephrase the question?
My question is the following. You are mentioning that the company is doing good on ESG, and the ESG is positive, and it actually influences the valuation, and it goes upwards because of the ESG. My question is, how exactly does it work? So if you see companies are strong in A, B, C, D, E aspects of ESG, how does that really influence company valuation, revenues, or profits?
Absolutely, I would love to take that question. Zia, could you please move to slide 24? So the way in which Nakilat's ESG performance has impacted our valuation is actually we have downgraded our valuation from a 35% upside to a 25% upside because of certain their lagging practices in terms of their GHG emissions per revenue, as well as their the board structure, the amount of diversity in their board, as well as staff. And the way in which this has influenced our valuation is through a higher beta in our DCF model in order to reflect higher risks that investors would perceive for the company because of certain regulatory risks, it may be, but also through the environmental risks that the company faces. As for our DDM, the higher beta translates into a higher cost of equity. And on the other hand, in our relative valuation, we believe that there are certain practices that their peers undertake which are not being followed by Nakilat, and therefore we have taken a discount to the industry peers, industry multiples as well.
So you are making an assumptions on investors' assumptions and perception of various ESG-related actions of the company. Is that correct?
Absolutely.
Thank you.
You mentioned the Red Sea crisis will have a huge impact on your target price and valuation. Can you run us through a scenario?
Hello, yes, I'd like to take that question. Can you please go to H1? So when we first address this, I'd like to talk about the Red Sea tensions. So as we know, there's an ongoing geopolitical tension going on in the Red Sea. Any escalation could cause the Strait of Hormuz, a critical route for Nakilat's vessels, to be closed off. This will result in rerouting, which will have to go through the Cape of Good Hope, which will increase voyage time by around 10 to 12 days. And this will lead to higher operational costs. However, like we said, one of Nakilat's advantages is that they're taking part in take-or-pay contracts with full cost pass-through, including insurance. So these additional operational costs that are being added up are actually going to the charterers, not Nakilat who's taking these on. However, we are seeing that the investor sentiment could be affected by these escalations. And that's why we decided to change, which will impact the equity risk premium, which is why we did on our scenario analysis, scenario simulation, we increased our equity risk premium from 1% to 3%. As you can see from in the minor and moderate escalations, we're seeing our target price, our upside going from the 35% to 26% and 18%, still giving us our recommendation of a buy. However, if there is a major escalations, we are still seeing we're seeing an upside of 11%, giving us a hold recommendation. Thank you very much.